Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, with the Moose, John Musso, our CEO, Director of Fixed Income. December 20th, as we round out 2024. This week, action on both sides of the market, fixed income and equity. I have some thoughts in what we saw in the equity market. I'm going to share a chart with you and a couple of ideas. But let's start off with the Moose, off the Fed meeting and the Fed comments. Talk about bond land.
Scared the heck out of everybody. The market got what it expected. That was a 25 basis point cut in the Fed funds target rate. Nobody thought it was going to be anything else but that. It was that. And then the language scared the heck out of everyone. The language was, we're a little concerned about inflation. We've shifted our thoughts about labor being more concerned. Now we're back on inflation. And don't expect a lot of rate cuts next year. And that kind of shifted the bond market back to what we talked about last year so many times, higher for longer. And when they think about higher for longer, what do? They boost longer term yields. So we saw the 10-year Treasury bond yield move up this week to a 452. It was about 10 basis points higher yesterday. We improved today because of a good PCE number. So that was a good way to end the week. But muni yields also up because you had some bond fund liquidations this week for the first time in a long time. 10-year AAA's at a 308. So here you have yields higher, but the actual inflation number lower than expected. So it tells you that the market was scared. It certainly had a different tone on it Wednesday when you saw the damage that was also done to the equity markets Wednesday, although there's been some rebounds.
Yeah, there was some. You know, in the back of my mind, John, we've heard, especially back in 22 into 23 when rates were being taken up, we heard multiple Fed governors talk to the 1970 mistakes that were made with interest rates.
Certainly.
And that was the fact that they did boost rates, trying to get inflation under control. And a number of them have mentioned they felt the Federal Reserve back in the mid-70s cut too quickly and it reignited inflation.
Right, and they do not want to live that again.
And they've mentioned that specific time period. So listen, I think I mentioned last week, other asset classes can live, I think,
certainly, in
a interest rate environment where 6, 8, 10, 12 months from now, the T-bills are at a 375, a 4, the 10 years at a 440, 30 years at a 5. You know, I'm making numbers up here, but historically, the economy can operate in that area.
I think, you know, just today where you had a PCE number, the Fed's favorite measure of inflation comes in at 0.1. Markets are expecting 0.2. Multiply 0.1 by its 12. You're talking about a low inflation rate. I think the markets took solace from that today. Combine it with yesterday, a lot of the damage from Wednesday all undone in the equity markets.
Yeah, and Wednesday, it gets to positioning, right? We try to talk about trading in our videos as much as the strategies and positioning. And when markets are positioned for an outcome that they don't get, there can be volatility.
Right.
And we saw significant. We saw a 2.5%, 3% drawdown on Wednesday. We saw some other sectors and industries get spanked a little harder than that. Thursday, back and forth. You know, any day like that brings out a lot of negativity from market observers. Let's just, maybe not in the portfolio management business, but observers.
Who poke up their head and say, this time it's different. Yeah.
And we saw that again. And, you know, one thing I always fight is trying to not consider myself a bear or a bull, but an opportunist.
Right.
And anytime you get those 2.5%, 3.5% drawdowns, you have every perma bear has missed the last 40% planting a flag of, see, I told you so. And data is interesting, right? Something I saw going around over the last couple of days was here the market is within 5% of, the S&P is within 5% of all-time highs, yet 8% of S&P 500 stocks are making new lows. And I want to share this chart with you. That all by itself has been a correlation to weakness in the equity markets over the next 30, 60, 90 days. Weakness,
Right.
not catastrophe, but often, especially on the back of really strong equity markets, we hear a lot of talk about topping. The top is in, the top is in. Number one, nobody knows when the top is in. We can look at data, we can look at flows, we can look at a number of things. Here's why
Might get exacerbated at year-end stuff, too.
of course, it gets a little thinner. Here's some interesting information. Let's take a look at this. New lows by sector. Look at the bottom here, financials. That's banks, insurance companies, broker-dealers. 0% made new lows on Thursday. Why is that important? It's important because if I go back to the last two really extended drawdowns off of tops, it would be 2008 through into 9 and 2000 into 2001, 2002. Let's take a look at real data to try to draw differences. In summer and fall of 07, still a full 6-8 months before the market got very rocky. Financials, 20 to 30% of financials were making new lows.
Wow.
This is 6-8 months before the real, I won't say it, hit the fan. Let's go back to fall and winter of 99. Even in fall or winter of 99, on the back of some really speculative behavior, I remember it well.
The dot-coms. Sure.
Right. The percent of financials making lows ranged between 10 and 30%. That was a warning of systemic problems. Systemic being market, can't get out of the way.
Right.
We're not seeing that today. Now, are we going to see that? Could we see that? Of course. But let's keep our eye on financials, even though it's a growth tech market from a risk standpoint, and we saw a dose of that in 22, John.
Right, absolutely.
With the Fed raising rates, banks couldn't get out of their own way. It wasn't as severe as 08 and 2000, 2001. But don't forget, just 24 months ago, it was nasty.
Right.
S&P intra-year was down 25%. NASDAQ off its highs down 33%. Let's keep an eye on those financials. For now, we're going to treat this as a pullback that can be bought or added to. So keep an eye on some of what we're doing within the portfolios. I will report that to you next Friday. John?
Nothing to say except we hope everybody has a great, happy holiday. We appreciate you being along for the ride with us this year, and we're looking forward to closing out the year with you after Christmas.
Thank you very much. Happy holidays.